Hi there. Thanks for tuning in. Today, we're going to be doing an updated for 2025 analysis and valuation of the gambling.com group. So, I analyzed this stock about 2 years ago or so. I want to do an update on it because a lot has happened since, and I still find it a very interesting company to analyze. So, let's review very quickly what they actually do. And unlike what the name gambling.com would suggest, they are actually a provider of marketing and sports data services for the global online gambling industry. So, what they do is they send customers to those online casinos and sports books. So, instead of actually being the place where you place the bets, they're almost like a lead generation or a marketing company rather than the actual gambling place. So, that's very interesting. Here's a good comparison. So, they're saying hotels acquire customers from comparison shopping websites like booking.com, hotels.com, Expedia, etc. Lenders acquire customers through sites like NerdWallet and Bankrate, and online casinos would acquire customers through sites like gambling.com and bonusfinder.com. So they're closer to something like an Expedia or a NerdWallet than to something like a DraftKings, which is the actual sports book. So that's very important to understand the nature of this business. And that does mean that they're less likely to shut down anytime soon, but they're still subject to the whims of regulation, of course. Now, another way that they make money is through consumer subscription services and enterprise subscription services. So, if I want to do a lot of sports betting and I want data, I can subscribe to their monthly or annual packages and they'll give me sports betting tools, a lot of data, news, etc. And media companies can do the same for a larger enterprise subscription. And that's pretty cool because that's stickier revenue. Sticky being that it tends to have less customer drop off. In general, subscriptions are notorious for just keeping more revenue in the bank. They may be a little tough to implement at first. You may lose a few customers at first, but at the end of the day, you may just keep more money. So that's interesting. Here you see their historical financial performance, where compared to 2022, even the first quarter of 2025 has quite nice numbers. So almost as much free cash flow in the first quarter of 2025 as there was in the whole year of 2022. That's pretty cool, actually. And new depositing customers, you can see the growth in just one quarter. It was about half of what they gained in 2022. So that's really, really cool to see. Another interesting thing is that they're going to keep expanding their market share. Some of it is organic growth, year-over-year organic revenue growth of 2% in the fiscal year 2024. Now, note, that seems like very little, and you'll see in the financials that their growth is more. What does that mean? It means that they mostly grow through acquisitions. So, not that many more people are visiting the gambling.com website, for example, or properties they already own, but rather they're also acquiring companies that bring even more people under their books. And those other companies, those other marketing gambling companies are growing quicker probably than their own at-home tools. So that's important to note, but they are looking to expand as regulation changes in the world into Europe, Canada, and Latin America, as well as doing more acquisitions. So they want fewer but bigger deals. So they will drop, and actually, I think they just announced a pretty big drop of money to acquire another company. So that's what they do. They try to be strategic, they try to bring a lot of companies into the fold and grow their market share through that. Now, the risk this carries is that they overpay for these companies, and that will be listed in the goodwill, in the balance sheet, and they'll eventually basically take a loss to their net income to recognize that goodwill. A lot of companies have this, but it's a sneaky form of valuation there. If we look at the financials since 2019 that they became public, their revenue growth has grown stratospherically, just so much. Here, you finally see slowing revenue growth. I mean, it was meant to happen, but still, double digits is amazing in general. Obviously, you're not going to keep an 80% revenue growth forever. That's very, very hard to do. You see some slowdown, usually some slowdown uh, brings investor panic with it. The gross profit margins are absolutely insane. And the reason why is because you'll see that's basically how much you keep from producing one extra unit of your product, which In reality, for a digital product such as marketing leads, it doesn't necessarily cost more. So this makes sense. Don't get freaked out by the high gross margin, but an operating margin, once you take your cost of operations, your marketing, etc., research and development, then it goes lower. But this is still holding steady at almost 30% for an operating margin, which is really freaking good. And then you have other values like the return on invested capital, which is picking back up. So overall, just healthy margins in general, healthy stats, basically. Now, I'm going to do a valuation here. This is going to be based on uh, what is the percentage of revenue that they usually turn into free cash flow. Here we see sort of what the last 5 years have looked like, and they retain an average of about 25% of their revenues into free cash flow. And so I can say, I can look at the analysis tab in Yahoo Finance to see what 7 analysts in general have estimated to be their revenue in this coming year and the year after that. And I'm going to take the low estimate here just to be conservative, just to have a margin of safety, right? And I can say, okay, I'm going to apply this average here to these numbers. Or instead of doing a historical average, if you want to be more conservative like me, I'm just going to take this 20% number and apply it to these two values. So that's what you'll see for my projected cash flow for the next 2 years. And then I'll grow it a little more. So what I'm doing here is I'm going to apply that to the estimates. And then I'm going to be growing this by roughly 10% for 2027, 2028, and then 3% in perpetuity. So you take all those cash flow values plus the terminal value, which is growing at 3% in perpetuity, you divide it by the total number of shares, and the fair value for gambling.com would be $13.68 a share. They do have a little bit of debt. They may have more in the future if they do more acquisitions and pay for it with debt. So that's important to note. That will affect the value. But if you subtract the debt from the actual valuation, then the fair value post debt would be $11.54. So let's compare that to where the stock is at right now. Wow. So, first of all, pattern emerges. And usually I'm not one to look at charts much, but something interesting to note here is in about mid-year, there's always a little down here. So it's been down here in the middle portion of the year. It went down in the middle portion of 2024. It went down a little bit in the middle portion of 23. It went down in the middle portion of 22. Now it's down a lot. So note how it was way above the fair value I had. Now it's a fair bit below. So what's happening here? Well, there is some seasonality. So earnings through gambling are boosted in the winter when the NFL is in full force, when European football, that is more so the Champions League and whatnot than the actual leagues, are in full force as well. So you always see this little depression and then this pickup back in winter where they may beat earnings expectations then. However, a sticky subscription model could prove very fruitful for the future of this company that will make those slow summers a little more bearable and then those winters maybe even better. So, an entry point may be presenting itself right now for those who feel confident understanding the business model and the valuation here, and if you agree with the numbers I had. And last time I analyzed it, I got a fair value of about $9. It clearly has improved because they're bringing in more cash flow, they're bringing in more stuff. They may buy back shares. They haven't bought it back yet, but they have authorized certain amounts of money to buy back some shares. However, regulatory fears, which will always exist, and a lack of a defined moat are always risks to take into account. So if you're going to hold this investment for 10 years, you have to understand how easy is it for another player to come in and how many competitors do they have? Or will the sports books themselves just kind of not um, do much with gambling.com and will try to acquire their own customers instead, which would be a little cheaper for them. And then what's regulation going to look like? Are countries looking to restrict it more or are they looking to authorize this more? If you have a good understanding of this, it may be a fantastic investment for the long run. If not, well, it depends on your appetite for risk. However, the time to buy will always come. As you see with gambling.com, there were some decent times, like here and maybe now, and there were some terrible times to buy, like these values that were in near the $15 level. So there will always be a time to buy, but you will need a lot of patience. And most days, your move here, quote unquote, is to do nothing. Now, I hope you learned something. And of course, I would really appreciate it if you liked and subscribed. It really helps me with the algorithm. Thank you so much for watching. If you have any more comments or questions, feel free to comment down below. I'll be happy to take a look and I reply to every comment. Thank you so much once again, and have a great rest of your day.